To some extent, I think that the two-year yield is as the best indication of future policy, that was simply too low when we went through the Silicon Valley Bank crisis, and we've made up most of that drop, and we should actually be higher, because if that group of FOMC members is right that we have inflation that we can't just bring down so easily, then the 2 years should at least be at 5.5%, so matching where the median of the Fed is currently. Same for the 10-year, you should actually be at 4 or higher, because that's reflective of a let's say, not only hawkish Fed, but it's also reflective of an economy that's stronger, that keeps inflation higher. So to some extent I've adjusted higher, Juliana, but I don't believe that the 10-year will go all the way to 5%. Though. That I don't think we're there yet.
That you don't necessarily believe that we'll get there, because the rhetoric around the economic outlook was actually marginally optimistic, I would say, relative to what we'd heard before. The Fed economists think that narrowly avoiding a recession is almost as likely as the mild recession baseline, and that sounds, fairly, I guess optimistic, maybe too strong a word, but somewhat optimistic. Do you think that the Fed is going to be able to achieve a soft landing, or is the fact that you don't think they're going to actually proceed with the projected rate hikes a sign that you don't in fact think they can pull it off?
So the Fed is actually confident that they can. Although they've always said that there's a narrow path, as they call it, but they are sounding quite confident that they'll be able to with this strategy that they're following. And actually, that is a good point, Juliana, about that section on the staff, because the staff in the previous 2 minutes had indicated that they expected a mild recession by year end. So they've downgraded that to something much more of an like almost even outcome. We could actually have a soft landing. And so I think that the Fed not only wants this, obviously, but is confident, and that confidence is really important to financial markets. If they were much more negative on the economy, then the outcome for markets would be much more negative too. So I think that explains why we're having a bit of a rise in rates, and people are feeling like, yeah, this is an economy that's resilient. By the way, that's a word that showed up 11 times in the minute, so I think it's an important word for their reaction function. Resilient economy that could lead to the soft landing.
When you look at how quickly and how high rates have risen in the last year or so, it is pretty remarkable that the U.S. market, the financial market, and the U.S. economy has been resilient. It has held up really well. Is there a fundamental decoupling that we're witnessing now between interest rates and the real economy, or is it just that the moment of reckoning hasn't come yet?
There's some of both, I think, but it's interesting that indeed interest rates haven't had the impact that people expected to have. The housing market is the clearest example of it, and that is a supply and demand imbalance, but that's caused by the pandemic, specifically to the home stay-at-home economy or work-from-home hybrid model. That what Williams yesterday actually highlighted, that is impacting services much more significantly than before, and that leads to this higher, stickier inflation, and why interest rates, as they've risen by 500 basis points, isn't really affecting the economy with a way that people thought it would be. An inverted yield curve, while we would see a recession by now, and that hasn't happened because of that hybrid model that we're still in. On the other hand, there will be a point that rates will be restrictive enough that they are affecting inflation and therefore the economy pretty much everywhere in every sector. I think it's just more of a juncture that we're going to, that meaning the service economy will start to cool off as demand just by nature cools off over time, specifically I think on leisure. And on the other hand, it's then rates are that high that savings start to increase more, and that will cool off the spending splurge that we have been going through.